Good morning, everybody. Welcome to the Hoover Institution's Washington, D.C. office. My name is Mike Frank. I'm the director here. I want to welcome you personally to this event. We're talking about governance at the Federal Reserve, and we have an all-star panel, an all-star cast of characters here to go into all the details and present their findings and papers. And I'm going to turn it over to John Taylor, our senior fellow professor at Stanford, and a wonderful expert on everything related to the Federal Reserve. John?
Okay, thanks, Mike, and thanks for coming. We're going to talk about a conference that began about a year and a half ago and developed into a book, a beautiful cover. Innovative thinking about these things. And we're going to just basically give short presentations, a few minutes to get us going, right in alphabetical order, starting with Mike Bordo and John Cochrane, Charlie Plosser, myself, and Kevin Warsh. And we'll sort of go through our little opening, and if you have questions about that as we go, that's fine, but we'll have a good discussion after we make our short presentation. So hope this will be talking amongst ourselves and talking with you, but anytime you want to jump in, that's fine. So let's start with Mike.
It's a great pleasure to be here. I just flew in from Berlin last night. I was at the G20 event. I'm the economic historian, so I always end up sort of giving the big picture, and I will try to keep to the time minute. I always have more slides than I need. So I basically am looking at the issue of Fed governance really from the perspective of the history of the Federal Reserve. Okay, most people focus on today. I'm going to give you the context of today in terms of the context of the past. Okay, so since the financial crisis, there's been a lot of interest in Fed reform. People blamed the Fed for the crisis at the time. They still blame the Fed for the crisis. The Dodd-Frank Act, in a sense, took on these criticisms and did a lot of things, but it made some minor changes to Fed governance. The key thing was removing the voting rights of Class A Reserve Bank directors, and also limiting the 13.3 discount window lending function. Now, there's been a number of people have argued in the last couple of years that there should be some really major changes in Fed governance. Some people have argued that the Reserve Bank presidents should be appointed by the President of the United States, and they've talked about a democratic deficit because they don't like the way the Reserve Banks have their own corporate structure. Some people think, well, the real problem is with the New York Fed. We have to do something about that. But now the interesting thing is that the same kind of criticism, not the same, but not that different, occurred after the Great Depression, the Great Contraction, 1929 to 33, which was blamed on the banks and the Fed. And Roosevelt talked about the banksters. And that led to major reform of the Federal Reserve System in acts in 1933 and 1935. So what I do in this paper, in this chapter of the book, is I look at the historical record on Federal Reserve governance, and especially the relationship between the reserve banks and the board since 1914. And I basically make the point that the Federal Reserve, the federal structure of the Federal Reserve System, is a good thing, and it shouldn't be changed. If it's changed, it should be changed in minor ways. I think that it's really contributed to some of the successes that the Fed has had. Okay, so briefly, I won't go through all this stuff. The Fed was established in 1913 after a huge financial crisis in 1907. There had been many other financial crises in the national banking era, and there was an ongoing debate about Fed reform and a Fed reform movement. And there was also, the issue was, many people wanted a central bank like the Europeans had, but there was also a feeling that we don't want what the Europeans have because our country is different. We want something with a federal structure. Okay, so there's a big discussion in my paper and other things I've written about the sort of process that led to the Federal Reserve Act. And in a sense, and I won't go through that now, but basically what we got was a compromise between those who wanted a sort of commercial bank-driven system and those who wanted the federal government to have more power. And so the Federal Reserve Act of 1913 represented what's called the Wilsonian Compromise, which gave a role to the regional commercial banks, that's Main Street, the money center banks, okay, Wall Street, and the federal government. Okay, and rather than a central organization with lots of branches, which is what one of the original plans suggested, okay, we got the semi-autonomous regional reserve banks with the board having this oversight role. And the reserve banks were owned by their member banks, and the governors were appointed by local boards of directors. And there were three classes of directors. This is really key to know this. Okay, so first you have these Class A bankers who were appointed by the member banks, by the member banks of the reserve banks. Okay, then you had Class B, were non-bankers also appointed by the member banks of the reserve banks, and then Class C, non-bankers appointed by the Federal Reserve Board. And the idea was that the individual reserve banks would set their own discount rates, and these would be subject to review by the board. So they really were thinking of a federal system with regional central banks. And the demarcation of authority between the reserve banks and the board was not clearly spelled out, and that led to some big problems in the 1920s and 30s. Okay, so I will go through those. I will go as fast as I can. Okay, so when the Fed started up in 1914, World War I was already going. And the problem was that the Fed really had to change its operations from what the framers had wanted, because now you're dealing with a war. And so what the Fed did, once especially the U.S. got involved in the war, is they began discounting bills backed by government securities. This was not in the Federal Reserve Act. And in fact, they set up a low interest rate peg, and they fueled inflation. So the Fed became very quickly an engine of inflation, and it gave up its independence to the U.S. Treasury. Okay, after the war ended, the Fed kept rates low to aid the Treasury, which helped fuel a commodities price boom and inflation. And then what happened was the Fed, faced with declining gold reserves, the Fed did not leave the gold standard. All the other belligerents did. The reserve banks reacted by raising the discount rate in late 1919. That led to a serious recession and a deflation, and there was a lot of pushback against the Fed. Friedman and Schwartz call this the Fed's first sort of major policy mistake, because they waited too long, tightened too much, and then loosened afterwards too late. Okay, then what happens is, once this is over, you get these series of conflicts between the reserve banks and the board, because they hadn't really set up a way of cooperating on how to do discount rate policy and open market operations. And that's because the original Federal Reserve Act wanted the reserve banks to do their own monetary policies. And in a sense, the board was supposed to be a coordinator, but they really weren't given much power, and what they were supposed to do was not laid out. And so what happened was the reserve banks set up their own sort of coordinating mechanism called the Governor's Conference in 1921 to coordinate monetary policy. Then the board jumped in, disbanded that conference, and set up something called the Open Market Investment Committee, which would coordinate open market operations at the national level. And that had the governors of the 5 eastern Federal Reserve Banks. So 7 banks were not included. Governor Benjamin Strong, a hero in Milton Friedman and Anna's book, governor of New York, became the de facto leader of this OMIC. And he was successful at stabilizing the U.S. economy in the 1920s. But the problem was that his actions were resented by the 7 banks that were not working out the deal, okay, as well as the board. And so there was this continuous conflict that was going on. And there are a number of examples of conflict that I will give, some of which you are very famous, others are not so well known. So one was in 1927. There was a meeting that was arranged by Strong between the central bank governors of the New York Fed and then the central bank governors of the UK, France, and Germany. And the idea was to create an international monetary policy coordination to help out the British pound, which was under threat. And the deal that came out, without going all the deal, is the New York Fed engineered lower interest rates than likely would have been the case given monetary conditions. Okay, and there was a big debate about this because it came straight from New York and not the other banks, and the board eventually went along with it. Okay, although Chicago didn't want to, and so what this meant was that much later, like we're talking in 1931, Miller, who was on the board, Adolph Miller on the Federal Reserve, he blamed this action by Governor Strong as fueling the asset price boom, the Wall Street boom, and the crash and the Great Depression. Okay. And then, so that's one example. And then in 1928, the Chicago and New York disagreed over raising rates to stem the stock market boom. In 1929, the board in New York disagreed about how you did it, whether you did it through credit rationing or raising rates. And the board blocked New York 10 times when it requested to raise rates. And then after the crash, during the Great Depression, Harrison of New York, he wanted to, expand liquidity to deal with the banking panics, and he was attacked by the board. Okay, so then what happened is the board disbanded the OMIC and created a new institution called the OMPC, which had all 12 bank governors. And Friedman and Schwartz again criticized this because, in a sense, now you've got 12 guys that have to agree, and he argues that it was very hard to make the committee. Friedman argued that to make the committee work. Now, the worst example of discord was in the first week of March 1933, which was the absolute bottom of the Great Depression. And there's a banking panic, there's an attack on New York's gold reserves. Okay, before it hit the statutory limit, New York requested a loan from the Chicago Fed, which had ample gold reserves. Chicago turned New York down, and the board refused to intercede. So what happened was the crisis didn't end. The Fed didn't end the crisis. It ended when Roosevelt came in and declared a banking holiday. Okay, so in a sense, these are examples of conflict, and Friedman sees this, and Schwartz see this as really one of the big causes of the Great Contraction. Other people think that maybe if there'd been more coordination, things could have worked better. Some people, Meltzer argued that it was the theory that the Fed followed, and that coordination wouldn't have mattered. Okay, so what happened was we did get reform in 33 and 35, but there's a question of did we really need it? Okay, in the reforms that were created, okay, in a sense, centralized power in the Federal Reserve Board. There were 2 Glass-Steagall Acts, and what happened was the 12 reserve banks remained members of the FOMC, and the board was given clear authority over initiating open market operations, but the Reserve Bank still had the option of opting out of board members. And the most significant changes were in 1935, okay, and this, in a sense, really consolidated the power of the board. And Mariner Eccles was the Fed chairman. He actually was a Keynesian, and he wanted both monetary and fiscal policy to increase aggregate demand. Okay, and so what happened later? Yeah, I'll take about 2 more minutes. Okay, what happened later with the history is that in the 1930s, the U.S. Treasury, in a sense, took over monetary policy, and the Fed was very passive, kept low interest rates. Okay, until through World War II, this led to inflation. Okay, after the war, the reserve banks began to push to regain their independence. Okay, and this started, okay, with the Accord in 1951, and there's a lot of here that I don't have time to go through, but the key thing is that the reserve banks began to play a very important role in the governance of the Fed. And there are a number of issues that come up, especially during the Great Inflation, whereby ideas coming out of the St. Louis Fed, which was the center of monetarism, okay, with its research director, Homer Jones, okay, and Darrell Francis, was that the Fed should focus on targeting reserves and monetary aggregates, okay? The board pushed back against this quite a bit, and the other reserve banks did too. But what happened was eventually, by the time Volcker came along with the Great Inflation so bad, they listened, okay? And one of the things that came out of that was the Humphrey-Hawkins Act of 1977, which set these ranges for monetary aggregates. There were other seminal contributions, okay, by the reserve banks in the period of the 60s and 70s. rational expectations in the vertical Phillips curve coming out of Minneapolis, price level targeting and inflation targeting coming out of Cleveland. Okay, there was a case against exchange market intervention by Richmond. The case against too big to fail came out of Minneapolis. And so the key thing is, and this is one of my takeaways, is the reserve banks had a strong voice during the Great Inflation and the Great Moderation. Okay, and then we get to finally the crisis of 2008. And again, Reserve Bank presidents, okay, one of whom is sitting right here, had a lot to do with sort of expressing concerns about some of the things that were going on at the board. Credit policy, the bailouts, etc. Okay, so they were very active. And so what came out of all this was, the financial crisis inquiry report of 2010 and Dodd-Frank, and in a sense they tried to deal with some of these governance problems. Okay, these are problems that were discussed going all the way back to 1910. And so the Dodd-Frank Act changed the voting procedures of the boards of directors. Class A directors could no longer vote for the president of the reserve banks. And then another key reform was limiting 13.3 lending, the lender of last resort function. So there's been a lot of backlash against the Fed since the crisis. Ron Paul called for its abolition. Conti Brown wrote a book about it. Okay, a lot of people, including Andy Levin, a board staffer, came up with plans for sort of, more centralization of the Federal Reserve. And so the point is, so there's a case that's being built against the reserve banks. I don't think it makes sense. I think history tells us that the federal regional nature of the Fed is one of its greatest strengths, and that reserve banks have long brought fresh viewpoints to the policy-making table. Research departments in the reserve banks have been behind many of the major improvements in Fed policy making. Okay, and this really enhanced the independence of the Fed. And I wonder if you had a monolithic Fed, like some of the European Feds, okay, and even with branches, okay, with the branches appointed by the president, whether you could have accomplished this. Okay, I don't think so. I think my reading of the history of central banks is that this wouldn't have been the case. Thank you.
Thanks, Mike. John?
So let me take just a minute to introduce the book and the project. We have an annual conference out at Hoover on monetary policy. John Taylor's been instrumental in getting this thing going and in herding us into doing it. It combines academics, media, and lots of Federal Reserve people. What we try to do in the annual conference is to get away from the usual will she or won't she, up 25 basis points, down 25 basis points, is it coming in December or next meeting that surrounds the Fed. And instead to focus on the deeper, more structural issues, the long-run strategy, the long-run plans. In this case, we focused on the deepest of long-run questions there is. How should the Fed be set up? What should relationship between the Congress and Fed be? What should the mandate of the Fed be? As Mike was pointing out, is it good to have regional presidents and these regional banks and a central Fed, or should the central Fed appoint the regional banks? These are sort of political economy or corporate governance. How do you get a institution to function well? And so a bunch of essays on it. That's what the painting is about. So he's the money lender, and she's the money lender's wife, and she's doing a lot of oversight because, see, she's looking at what he's doing. She's reading a Bible, so, some sense of make sure he's doing his thing. There's a little mirror with an open window. I'm not quite sure what that symbolizes, but if you enjoy reading symbolism into representational art, you'll have fun with that one. So that's the general question, and this is kind of an advertisement. We're doing one again this spring. Mike and I are in charge this time. We're not quite sure what the theme will be. That quality is more important than theme, but I can tell you themes other than when will the federal funds rate go up and down will be represented. And hopefully we can come back next year with something new interesting to say. So let me talk about sort of my views and a little bit related to my contribution on this question of governance and reform. But before you decide how how the Fed should be governed differently, I think it's important to say what needs fixing, what's broke and what ain't broke before we run the system. Now here I'm a heretic on this panel, and we're allowed to disagree with each other. That's the whole point. You never get to the truth unless you have some disagreement. As I look at it, I see at least the outcomes of monetary policy are pretty much okay. Inflation is very low. Interest rates are very low. The unemployment rate is back down to normal levels. I don't see the huge quantity of reserves as long as they pay interest. I think that's actually a useful innovation, and I hope we keep it. And I don't see signs that the Fed is holding interest rates down. The Fed is not lending out a lot of money to banks at low interest rates. The Fed is taking a lot of money in from banks. Interest rates around the world are low. I don't think there's a lot that the Fed can do about it. Now, is this benign state of affairs because of the Fed or despite the Fed? I'm not quite so sure, but nonetheless, the outcomes are okay. So what's there to complain about? Well, certainly I object to the talk. The Fed is widening the scope of things that at least says it wants to try to affect, to inequality, labor force participation. It's inventing new mechanisms, hysteresis. Its financial stability mandate is increasing. I'm not quite sure what that means. So here I think John Taylor will. Here's where I agree with John Taylor a lot. Certainly how the Fed talks about its policy is a problem. And it's partly a problem because federal funds rate changes have become like papal elections. You know, we all sit around and is the white smoke going up or the black smoke going up? And that's just not a good way, even if that's how it's made. You want to give the impression of a strategy of some stability. More deeply, though, there are actions of the Feds that I worry about. And those are not the liability side of the balance sheet, the reserves. It's the asset side of the balance sheet. The Fed has bought long-term treasuries, mortgage-backed securities. Last week started talking about buying stocks. Other central banks buy stocks. The Fed's mandate is now expanding to worrying about asset prices. Once you're buying stocks and interfering in the stock market, then you're manipulating stock prices. They said they were manipulating long-term bond prices and mortgage-backed security prices and worrying about asset bubbles. The mandate now is that the new talk is macroprudential policy. The Fed is not just monetary policy, it's regulation. And macroprudential is uniting regulation and monetary policy, using monetary policy for regulatory purposes, using regulation for monetary policy purposes. This scares me. The idea that the Federal Reserve, if it decides that there's a housing bubble in San Francisco, I just bought a house in San Francisco, they may be right, but that the Fed should look at this and decide, and then the macroprudential answer is, well, we'll just tell the banks to stop lending so much, because once you discover that interest rates don't really affect things that much. The Fed is the giant regulator as well. Under Don Franken already, they are the temptation to just directly interfere is stronger. Now, why is this a worry? First of all, do we want any agency of the federal government to be micromanaging the financial system, to be deciding what the appropriate level of stocks, house prices, bond prices, and the rest of it is? Is financial stability no longer just stopping runs and crises, but making sure that no voter ever loses money in the asset markets? That's a dangerous place to go. And more importantly, the deal in a democracy is that independence comes with limited mandate. The Fed is a very independent agency. I think we all value the independence of monetary policy. But you can only be independent if you have a small thing to handle and you worry about inflation, maybe a little bit unemployment, and maybe you're there with the fire hose for financial crisis. Once you start, if you want to do fiscal stimulus, helicopter money is writing checks to voters. That belongs in the Treasury, because that you need political accountability if you're going to do stuff like that. So if the things that the Fed is heading towards are, manipulating stock and bond prices, worrying about the price of houses in San Francisco. These are the sorts of things that you cannot remain independent if you do. So let's think now about the governance reform question. I would put 4 items on the agenda, and I'm sure we can think of more. 1, we need a new Fed Treasury Accord. We've lived through this kind of crazy world where the Treasury sells long-term bonds because he thinks the U.S. should finance itself more long-term, and the Fed buys them all back up again and undoes what the Treasury does. So who is in charge of the maturity structure of government debt? Let's decide that. I think it ought to be the Treasury, and I think the Fed taking onto its balance sheet credit risk, a stock market risk eventually, and things like that is a bad idea. The Fed's monetary policy should be about money. And if the Fed is going to be in charge of short-run manipulation of that sort, eventually get that stuff onto the Treasury's balance sheet, where the risks to the taxpayer are being managed by the politically accountable institution. We need to talk about the monetary policy mandate. I'd rather it were just inflation. I think that was a wise thing that emerged before 2007. But certainly, the mandate now, if the mandate is going to expand to be worrying about inequality, which maybe is a problem, but it's not the Federal Reserve's problem. And if they're going to become the giant macroeconomic manager of everything, that we need to think what the mandate should be, and I would argue for a smaller one. I think separating regulation and monetary policy is an excellent idea. The Fed is a very independent institution. They were really competent under Dodd-Frank. They got handed a bunch of regulation. But the independence of the way the Fed works, regulatory agencies, there is a legal structure. They are more under congressional control. I think the Fed's regulatory action should be like every other regulatory agency. Of course, the final question about the Fed is what should they do in crises? Are they a liquidity provider, or are they there to take care of shotgun marriages to bail out specific institutions? That Congress has already weighed in on that issue, and that's an important one to at least talk about with the governance. Thank you.
Thank you, John. Charlie.
Well, my remarks are going to follow closely on John's. My contribution in this volume actually talked a lot about some of the things that John was talking about. And so I'm going to pick up on some of those themes and maybe elaborate them on maybe in a little different way. So over the last decade or so, the Fed and central banks have generally come under a lot of scrutiny and criticism. You all know about that. I think this part is stemming from their own actions and choices they made as an institution. Not only the Fed, but also some other central banks around the world. And what's happened to monetary policy over the last decade is that monetary authorities, again, both in the United States and elsewhere, have gradually pushed the frontiers or the boundaries of what used to be considered traditional monetary policy. And of course, we all know what some of those things are. Of course, the bailouts of AIG and Bear Stearns, where the Fed engaged in the purchasing of highly risky private assets and put them on their balance sheet and bailed out these institutions. That's not, by the way, our lender of last resort function in a traditional sense of the word. Lenders of last resort, Badgett taught us, was you lend freely at a penalty rate to solvent institutions, not insolvent institutions. The other course of pushing of the boundaries was the aggressive asset purchase program that the Fed went under, but in particular, its asset purchases of mortgage-backed securities in order to help the housing market. And so both bailouts and large-scale asset purchases of MBS in particular were directly what we refer to as credit allocation schemes. They were providing Federal Reserve credit and funds to private organizations or private or individual sectors of the real economy in the case of housing. And of course, the other thing that pushed the boundary is clearly near zero interest rates for almost 7 years until about a year ago. Now, whether you agree with the choices that the Fed made, whether you thought they were good choices or bad choices, these actions raise very serious and legitimate questions among a lot of people about the tremendous discretionary power and authority that rests with our central banks. And of course, those questioning has led a lot to this notion of reform. So I think there are 2 points that need to be kept in mind when you think broadly about how do you think about reform. Mike gave a tremendous sort of history of the tensions within the Fed system. But I want to remind us of two very important points. One is most countries around the world operate in a fiat money regime. That fiat money regime says, essentially, that the currency has value because the government says it has value. It will extinguish all debts, private and public, and therefore it is declared valuable. And the role of central banks in most cases is to help preserve the purchasing power or the value of that fiat regime. Now, in the case of the fiat currency, in the case of the Fed, what it means is they have the authority to intervene in financial markets to purchase and sell securities in large quantities, if they so choose, and intervene in markets to control the growth of money and credit in order to achieve and sustain the purchasing power of a currency. That's point one. Point two is that I believe, and most academics and historians believe, that it's important to have, or that history teaches us that we need to have a separation between fiscal policy and monetary policy. That's just good governance. You need to have a separation between the people that tax and spend in the government and those that print the money. And we know that's important from history because we know that the temptation to use money creation as a substitute for tough fiscal choices, and by the way, we've seen a fair amount of that just in the last few years, leads to terrible outcomes, sometimes worse than other, but terrible outcomes. Just think of Argentina over the last 30 years. Stagnation, rife with inflation, financial turmoil, and a large part of their problem has been the ineffective separation between the fiscal authorities and the central bank. So what these points highlight is a point that John made. If you think about reform and you think about what about the central bank, you have this tension between preserving independence and the good outcomes that this separation of monetary and fiscal policy can have, maintaining that independence while at the same time granting a central bank the authorities and the tools to be successful in what you've assigned them to do. So and then the final point would be, how do you then hold the central bank accountable? So you've got a desire for independence, a desire to have the tools necessary to achieve the goals, and you have this problem of accountability. There's a tension between those things, and as you think about the institution and reform, you need to think how you're resolving those tensions and do it carefully. So, and in my contribution, I talked a lot about these sets of issues, and then I sort of focused on three topics, the way to think about that try to recognize the important interactions between these things. John mentioned one of them, for example, and that is simplify the goals, simplify the mandate. The broader the mandate, the bigger the mandate, the more room a central bank has for discretion to pursue various objectives. Those objectives can be desirable, but they could also be fiscal policy things, as we've talked about. They could be moving over time from one goal to the next. And broad mandates leave lots of room for discretion, but also broad mandates leave lots of room for political interference, directing the Fed to undertake certain objectives at one time and other objectives at another time. And the Fed, through much of history, I think Mike will agree with this, at times have been they've sort of chased one goal after another, futilely in many cases. So broad mandates, I think, are part of the problem here, and more narrow mandates would reduce mischief, reduce discretion, and help you make the Fed more accountable. Because with a narrow mandate, you can say, you're supposed to achieve X. Now, the thing you have to be careful about in broad mandates is that, like any business or any other thing, you don't want to give a mandate to an institution or a person for which they can't achieve. That's a recipe for failure. And you're going to guarantee failure if you assign the Fed or any other organization the responsibility to do something that they don't have the ability to influence. Okay? So I think we're going in the wrong direction, and John alluded to this as well. Over the last decade, I see the Fed's I see mission creep all over the place, whether it be financial stability, macroprudential policy, whether it be, as John alluded to, the Fed talking about, and I think they brought this on themselves, determining stock prices or equity prices, determining labor force participation rates, what they worried a lot about, determining real wage growth in the economy. And the belief that somehow the Fed and monetary policy had the ability to actually shape and control those in any meaningful way. So that mission creep is terribly bad news. I'm kind of reminded there's an old saying, responsible for everything and accountable for nothing. That's kind of what we're getting. It's very hard to hold somebody accountable when they have got responsibility for all this wide array of things. And again, whether it be stock prices, income inequality, you can just go down the list. So I think we've actually come to expect way too much from monetary policy. I argued for years when I was at the Fed about some of these issues and tried to raise them. But this mission creep is, I think, very problematic. I'm reminded of a quote, one of my favorite quotes that I've used many times over the last decade or so, by Milton Friedman in 1967. And he said, "We are in danger of I'll get this quote about right. We are in danger of assigning monetary policy a larger role than it can play. We are in danger of asking it to achieve tasks, to achieve tasks that it cannot achieve, and in so doing, putting at risk the contributions that it's capable of making." Boy, I don't think there's any better message for today. In fact, it's even more applicable today than it probably was 50 years ago when he said that. So I think we need to scale back expectations of monetary policy. And one of the ways to do that, as I've already alluded to, is reduce the scope of discretion, narrow the mandate, and hold the Fed accountable for a more narrow mandate. And that's kind of what I argue in the talk in this book. There's another way to sort of begin thinking about constraining the Fed that might make it held more accountable, and that is to reduce the assets that it's eligible to buy on the balance sheet. So the Fed, obviously, through Bear Stearns and AIG, bought lots of private sector securities. For SOMA account or for monetary policy, they bought both treasuries, which is traditional, but also mortgage-backed securities. Much of the bailouts, so forth, and the mortgage-backed securities are credit allocation schemes and thus fiscal policy. I do not believe that independence of the Fed should include the ability to conduct fiscal policy. That's not in its purview. And to the extent that the Fed has the discretion to engage in fiscal actions that ought to be in the purview of Congress or the fiscal authorities, it undermines their own independence. And I would argue that if you look at this last 10 years, that's exactly what's happened. The fragility of the Fed's independence is really at risk today. Just ask yourself what happened a year ago with the transportation bill when Congress couldn't figure out how to pay for it, so they raided the Fed's balance sheet. Direct interference by the fiscal authorities to undertake fiscal actions and use the Fed to achieve those. So I think there's plenty of reason. And so it's going to undermine independence, and it's going to put the Fed and the institution at risk. So I want to mention one last thing about monetary policy, because this episode of financial crises and independence is an important one. A lot of people argue, and the Fed did this very, very strongly, a lot of people argued that the Fed had to go in and, let's say, bail out Bear Stearns or rescue AIG or however you want to think about it, that was essentially because the Fed was the only institution that could do that could act quickly. That doesn't have to be the case. It doesn't have to be the case. I would argue that, again, if the goal is to preserve independence and to preserve the ability and the accountability of the Fed, back in 2010, I gave a long speech about this in New York, And I said we needed a new accord, but it was a little different accord than the one you're talking about. We needed a new Fed Treasury accord, and that is that with the question of, and again we were talking mostly about Bear Stearns and AIG at the time, what we really needed is an accord between Treasury and the Fed, where the Fed is not allowed to buy private sector securities, either in the form of bailouts or stock equity prices. We needed an accord that said if in fact there is an emergency and there's a crisis, and crises happen obviously, what role should the Fed play and how should it relate to Treasury in that crisis? Well, my argument is a fairly simple one. It's simple, at least on the surface. Obviously, the devil's always in the details. But is that there needs to be a Fed Treasury accord where the instructions to the Fed, as the government's bank, the Treasury can instruct the Fed to engage in a purchase of private sector securities in the case of an emergency. And they can request that. But the key difference is, and particularly if it needs to be done in a timely way, the key difference is that there's an ex ante or a pre-agreement that says if that's the case, the Fed agrees and the Treasury agrees that within some interval, let me say 6 months, a year, define some interval, the Treasury will take those private sector securities off the balance sheet of the Fed and swap them for Treasuries. Because this is a fiscal action. The fiscal authorities need to take account of that or need to take responsibility for that, and putting those private sector's assets in the Treasury instead of at the Fed, swapping Treasury securities allows the Fed to then continue to conduct monetary policy as it should without being interfered with all this other stuff. So in the case of Bear Stearns, where they created these maiden lane security bundles of private sector securities, the Treasury would have taken those, given the Fed Treasuries in exchange, and the Fed's balance sheet would have still been clean and an all Treasuries portfolio. So there are ways to do this without dragging the Fed in to these fiscal policy actions. So I'll just stop there. Thank you.
Thanks, Charlie. Let me take a few minutes to describe how this research, these conferences, these books interact with what's going on in Washington and other places. I've always thought this connection between ideas and action is a fascinating thing. So these conferences began in 2014 as part of the centennial of the Fed. And some of us were thinking that there were lots of conferences for the centennial, but many of them kind of were congratulatory in many respects. And maybe focused a little too much on the discretionary actions, shorter-term actions, where a number of us thought that a greater focus on sort of more systematic rules things that could work better would be good to focus on. So we decided to have our own centennial conference, and that was the first in the series in 2014. And it did focus on the kind of things that my colleagues have been talking about already, and Kevin will as well. And so, for example, we had a paper by David Papel, who presented it from University of Houston, showing historically why a more systematic rules-based policy works well, and why when we deviated from it, and it was a big deviation, in 2003, 4, and 5, things got really bad. That there was a lesson to learn, and in some sense, the lesson continued. And we had other work like that. What happened after that is actually quite interesting, because maybe not exactly after, about the same time, we began to hear about legislation moving to actually make some changes which would encourage the Fed to move in that direction, coming out of the Congress and Financial Services Committee. And so that was encouraging in a sense, to have that connection. Maybe you never know where it occurs, why it occurs, but connection. So we had another conference, and that's really what this book's about. And so we delved into these issues more, and you can hear from my colleagues what that's about. But a couple things not represented in this panel, which were part of that. One was to let's do some research on those proposals. Let's take that Form Act or these proposals, and let's do some research. How would it work if those were in play during the crisis? And so a terrific paper by Carl Walsh investigated that. How would it work is it important to have the Fed focus on its strategy as distinct from its goals? There are two different things. The strategy is how do you achieve the goals? The goals are things like we've been talking about inflation, for example. Is it important? Does it improve policy based on models that we use and ideas and empirical? Does it improve policy to have the Fed also focus on the strategy? And the answer is yes. You have to do both of those things. So is it in a sense of feeding back off of what is happening. But then since this conference, it was a year and a half ago now for this book, enormous number of things have happened. You've had the Reform Act pass the whole House of Representatives. You've had a similar bill in the Senate. And a lot of debate in public. Many of you have written about it on one side or the other. It's really amazing how these ideas in action are beginning to move. And so now it's even moving further. We've got an election, and there's differences of opinion coming out there that we haven't heard before. And to me, it's in many respects in these dimensions encouraging. We'll see. So we're going to continue this. We had a conference, which we'll have Michael Bordo and I doing a book, which is on the international aspects of this. Then you say, well, what about the Bank of Japan? Look at their policies. Look at the ECB. Buying equity is sort of going all over the place. Negative interest rates, big negative interest rates. So it really becomes an international monetary reform issue. And what the Fed does, what we do in the United States, whether it's through legislation or it's done by personnel action, has an enormous impact globally. So you'll hear about that the next time we have a conference here. Kevin.
Thank you, John. So guys, thank you very much for joining us. I can't help but note, being the fifth of these speakers, that what we're really all talking about is fundamental reform. All of us on this panel believe in the importance of the central bank, believe in the critical role of the Fed. And what we're all trying to say, I think, in our own way, is that this is an institution that ought not be resistant to reform, that ought not be defensive, that ought not think that everything they did after the fact had to turn out to be exactly right. And so if over the course of our discussions in the hallway at Hoover, over the course of the discussions in the next hour, we can elevate the reform agenda, where you'd have fundamental reform, or at the very least, a robust discussion of fundamental reform, which I would favor, others might disagree with, on what the Fed's strategy is, what its operations are, what its communications are, and what its governance is. And I think that might be a little less newsworthy than the latest monthly payroll report, the latest breathless moment of the next press conference, the next series of dots. But I'd argue it's far more consequential to the success of the Fed as an institution, to the strength of the economy, to the integrity of what we're trying to achieve. A late, great fellow, Hoover, mentor of many of ours, wrote to Paul Volcker in 1979 a letter upon Paul's elevation to being chairman. And in the letter, he noted whether he should congratulate him or offer him condolences. In the letter, he said, and I quote, "I do not believe that the system can rise to the challenge without major changes in its method of operations." And that was Milton Friedman to Paul Volcker in 1979. I think that it was as true today as it was then. And what we're trying to achieve in the context of these discussions is to elevate that reform agenda. It strikes me that policy is neither made by unfettered discretion, nor is it made by some obedient following of a rule, no matter how useful the guide. It's made by committee in an institution, and those institutional dynamics matter. And the purpose of our discussions a year ago at Hoover, and virtually every day we see each other in the hallway since, is how does this institution operate? Can it prove successful? It strikes me that's a function of its statute, but not just its statute. It's also a function of its history, which Michael talked about. It's a function of its culture, words that we're not supposed to utter in the field of economics these days. It's a function of personnel, who is there, who are the 23,000 people at the Federal Reserve every day, who's leading the institution, who are the 550 PhD economists who should be struggling about these hard questions instead of debating whether September or December makes a difference to the long-run strength of the economy. It's a discussion about the processes and settings in which policy is made. And lastly, and maybe most importantly, it's a robust discussion of ideas. It is a humility that I want you to hear from the five of us about how to take this economy and make sure it is stronger, and how the Fed can play an important and supporting role without overstretching its boundaries. I'll note a few things, then turn to one of the pages in the book to help frame the discussion over the course of the next hour. One is, this is an institution, and we might call it the Greenspan Fed or the Bernanke Fed or the Yellen Fed, but it has complex institutional dynamics. I'll note a few things which were in my paper in this. One is, all institutions need a limiting principle. If, in fact, there is no limiting principle, it becomes a general purpose agency of the government. It becomes a repair shop for broken economic policy outside of our window. As my colleagues talked about, I think very well, that is a dangerous idea for the Fed. Second, institutions need a strategy. And we might hear every January that they just publish this one-page, 5-paragraph document called their strategy. But a strategy is only a strategy if it's operationalized, if it's followed. One of Charlie and my colleagues from the crisis years famously said that a plan beats no plan. And everybody sort of shook their head in the darkest days of the crisis and nodded some degree of approval. Well, strategies beat plans because plans are fleeting. Strategies endure. And as we listen to the commentary and to our colleagues, our former colleagues at the Fed, I hear plans all the time, and then they get interrupted by events, like the stock market falls 5%. Like they got a piece of data from the Bureau of Labor or Bureau of Commerce that has caused them to fundamentally rethink their number of dots. This is a serious institution. We have serious challenges. The quality of this data upon which we're changing plans and strategies are really changing that much by a piece of data with a confidence interval of about 190,000. So institutions live and die on these things. They live and die on their credibility. And they live and die on their ability to set a set of expectations and live up to them. And I think all of us in the context of reform are sort of asking how that can be done better. And institutions, lastly, take cues from other institutions, abroad and here in town. And if in taking those cues, the Federal Reserve comes to the view that the rest of Washington's not working very well, that they should in fact adopt some Wilsonian view that, listen, we're nonpartisan folks, we're very talented, we're here to serve the public interest, all of which is true, and we can compensate for the failings of the rest of this town, then we've got ourselves a deep, deep problem. So I'll point you, if anyone has their books in front of them, if you'll point you to page 176 to make this really feel like a proper class. I've only been teaching for 6 years. John's been teaching for 30 and taught me, so you'll see I'm not a terrific teacher. But if you can turn to page 176, there's a chart. Now, I've learned in academia what we do is we should create charts, then borrow our own charts, and then plagiarize those, and then reference those in our teaching. So that's what I'm doing. So on page 176, there's a simple graphic, and it is how, in my view, I borrowed this from a report I wrote for the Bank of England, how institutions should make good decisions. And for those that don't have the book in front of them, in the middle of this is rigorous decision-making, the sort of sine qua non of trying to get these hard things right. And there's three things that fall into it. One on the top is called genuine deliberation. I would suggest that the five of us have more debate inside the halls of the Hoover Institution, where you might think we all agree on everything, about these hard and difficult questions than the minutes seem to suggest happened at these incredible times in the post-crisis period. So this is a call for genuine deliberations. This is a call for a diversity of ideas to inform the conduct of monetary policy. And if out of the 500 or 600 PhD economists at the Fed, 90% of them basically agree on the model, born in 1978 and embedded in the dynamic stochastic general equilibrium model that they use, it's hard to have a really robust set of genuine deliberations. There is an importance of having a diversity of ideas. Michael talked about this at the outset. This is a hallmark of a strong institution to have these. It is not suggesting that these ideas all have to be accepted, but they need to be in the public era. They need to be in the public space, and it's not at all obvious to me that they are. And you have to be unafraid to have that deliberation. I would argue that that deliberation is not about how many dots we're going to see in December. It is not about them forecasting and forward guidance whether they think they're going to raise 2 times or 3 times. That is not what are the fundamental questions. So I think that is a hallmark of rigorous decision-making at the Bank of England, at the Fed, and others. Also going into this chart, you'll see another box called high-quality inputs. The inputs that go into the core model at the lap of the Federal Reserve Chair that drives almost all the forecasts that we see about are inputs that rely on data from the Bureau of Labor and the Bureau of Commerce. And these might have been the best bits of data that we could have gotten our hands on in 1978. But if you think about the empirical work we're doing on the real economy, most of us are trying to use new forms of data, new data streams, new deep learning, new understandings to inform our judgments because, after all, we want the best contemporaneous view on what's happening in the economy. We do not want data that is, by definition, subject to massive error, backward looking, and is the best that could be garnered 40 years ago. So I question whether high-quality inputs are finding their way into rigorous decision-making. In addition, you would see that one of the high-quality inputs that they purport to use is the stock market, the spread in the high-yield markets. These could, in fact, and in my judgment, markets should be an important set of inputs to inform decision-making. But if you've spent most of the post-crisis era trying to set, manage, manipulate those asset prices, then instead of being a useful input to help you understand what the economy will look like over the next 12 months, they are a mirror of what you've said. So I know they go into these meetings, this was certainly true in Charlie's time and my time, and they say, we can or cannot do X at this meeting because market expectations are as such. Well, market expectations have been set by the same group of central bankers. I would like markets to help inform these, and if that means that on occasion, the markets are surprised by the decision that is made over a rigorous 2 or 3 day process, that's not just okay. That can make market information more useful. Third and final box that goes into this point of rigorous decision making is called optimal committee design. I spent a lot of time at the Bank of England for 6 months trying to think about how they could reform themselves, and they did a series of reports written by others. And unlike in the US, I would have thought these reports go on the shelf. In the parliamentary system, they become law. And they adopted and incorporated into practice fundamental reforms in how they do business. If you look broadly at the optimal committee design, both in central banking and broadly, and you look how this committee is designed, it is far from the frontier of best practice. And we wonder why, over 2.5 days of decisions, almost all of our former colleagues read from prepared text and offer their views on the economy, then they put those down. The other 19 people around the table speak in a room filled with 60 or so folks, and then they, the next day, read what they think the policy implication should be. I am not opposed to pre-written notes, though, as you can tell, I'm not famed for it either. But imagine if over those 2 days we listened to each other. We say, I hadn't really thought about that. What if the hawks decided to try to be the doves for a minute? And they interrupted each other and said, I don't really understand that. That is the indicia of a committee that works with a robustness of ideas, a humility about what we know. And as you read the transcripts that come from the last post-crisis period and before, you might ask yourself as you're reading those, how many people's minds were made up long before they came to the meeting? That is not how we answer these big questions. So the purpose of this meeting and much of our discussion since was about things like where should policy be, but it was also about these harder organizational characteristics, about how you end up with better policy, end up in the process where you've gotten policy about right, but you've done that in a way such that the integrity, understanding of what the central bank does and doesn't do becomes part of the fabric of the U.S. economy instead of the latest bit of news that drives the markets and media every 6 weeks. John, back to you.
Thank you, Kevin. So let's open it up. If you have questions or comments, start right here.
I'm Arnold Kling. At the end of Sebastian Malaby's biography of Alan Greenspan, he sort of asked the question, how did Greenspan become this discretionary wizard, given that really wasn't his background or thinking? And Malaby's conclusion is that is what ultimately the political process wants, is a discretionary wizard at the Fed. So do you have to fix the political process before you can fix the Fed?
So let me just say, so I did read that book. It's a great book, by the way. And I take it as something evolved, and the discretionary wizard part was more towards the end, 2002, 3, 4. And before that, it was implementing what I would think is a pretty predictable, understandable thing. In fact, that's where a lot of these ideas in practice about rules came from, is what he was doing. So the real question is what happened towards the end, I think. And there, I think it is more complicated than just one person's view. I think there are different pressures. The data were confusing. But it's understanding that 2003-4 period is so important to this whole discussion. Anybody else want to comment?
I don't think it's written in stone that we want discretionary wizards at the Fed. First, sort of reminded of these South Sea islands that have the God King who promises the great harvest. And then, of course, when the great harvest doesn't come, that's it for the God King who meets them. That seems to be how we treat our Fed chairs. But the other agencies, the Bureau of Weights and Measures, we don't ask for a discretionary wizard to alter the length of the foot when, there's a recession or something of the sort. We want the head of the Bureau of Weights and Measures to do their job within the limited constraints asked by Congress. We don't ask the head of the EPA to worry about, when we might start worrying about climate justice and things like that. But in general, most of the other heads of agencies are supposed to act within the realm of competence and the congressional limits that we ask of that agency. So the Fed has kind of brought this upon themselves. I think some of the problem therein is that their marketing operation has been so big on, we saved the world with low interest rates and QE, so it's kind of hard to turn around and say, now, low interest rates and QE really aren't causing any problems, so just leave us alone. If they just left the marketing campaign aside, I think they'd be in much better shape to just go forward quietly. So I think it's a two-way street. J. Edgar Hoover built the FBI around his personality, and I don't think Congress or the political system demands it.
So I'll just offer a simpler response to your question. So, I agree with much of what John said. You suggested that you need to get the politics fixed before you get the Fed fixed. I think it's exactly the reverse. I think that the Federal Reserve needs to stay out of politics, stick to its mission, reform its strategy, operations, communications, and governance. And in so doing, the weight and responsibility for the economy will have to be picked up by somebody else. Imagine in the post-crisis era that the Fed chairman were to, when they show up at their Humphrey Hawkins testimony on a semi-annual basis, gets a question from the senator who says, Madam Chair, Mr. Chairman, whoever happens to be running the show, people in my state are still struggling. What are you doing for these folks? Imagine if the Fed chair, with the unemployment rate approaching what they had previously thought was full employment, approaching what they previously said was their inflation objective goal, said, with all due respect, Senator, to you and your 99 colleagues, in the depths of the financial crisis, the Fed has this special role to play, born out of the panic of 1907. And we didn't get it all right, but our actions in the depths of the crisis should be fundamentally different than in the regime that followed, that we've been in since the second half of 2009. And if in 6 months people in your state and your district are struggling, as I'm sure they are, let me be clear whose responsibility that will predominantly rest with. And it won't be ours, it'll be yours. Imagine that discussion 6 years ago, 7 years ago, and ask yourself whether the politics would have changed.
Russ Roberts, I'm going to re-ask Arnold's question since he couldn't follow up. Some of us are upset about, say, the fact that members of Congress try to get the most money they can get for their constituents. And we say, that leads to kind of an unhealthy dynamic, a tragedy of the commons, bad governance, et cetera. And we say, wouldn't it be great if they just had the moral strength to say the Constitution doesn't really allow this? But if you said that as an economist, that was your way of fixing the waste and abuse of the congressional purse, you'd say, well, that's a little unrealistic. They don't have an incentive to do that. Their natural incentive is to take money and funnel it toward their constituents. So the idea, what I hear from you guys, and I love all of you, and you know how much I respect all of you, is, gee, I wish the Fed weren't political. And the way we're going to do that is we're going to just assume that there's a better Fed out there that isn't. But that doesn't exist. So to argue that the Fed's mission creep is a bad idea, and the answer has to be, the response has to be, well, what's the incentive for them not to creep? What's the incentive for that Fed, Kevin, to say, that Fed chair at that Humphrey Hawkins meeting, say, you know, I really wish I had less power. I should stick to what I did, to what we did 25 years ago when our job was, I got less attention at my press conferences, and the president wasn't happy, and the Senate wasn't happy to cede power to me. Because that's what they do with every single agency. The administrative state continues to rise. So I think I want to hear a strategy. I don't agree with you. I could be persuaded that we could fix the Fed first. I don't see the incentive for that. So if I'm right, how are we going to change the incentives?
So so we're talking about reform legislation. So there's things that are happening. But Charles, you want to?
Well, actually, Russ, I think that's a big problem because I think it's a problem because I think Congress, the legislative side of the House of our government, doesn't want agencies and people that work in the government who they can point their finger at and say, you screwed up, okay, and not them. And so they have a hard time in this whole political process of saying, we have to be accountable. They want somebody else to be accountable, and it's in their incentive at times to sort of provide things that I don't like broad mandates, even though they know the Fed can't be successful at it, but they have the scapegoat to blame and call somebody before Congress. I think that's a problem. I don't think it's a permanent problem. I actually think that there's hope for moving in the right direction, but there's a tension there that I think is real. I don't disagree with that, but it's hard. It is hard.
I just want to add,
Sorry, did you, Mike, just something?
And by the way, the book, I think the problem with Greenspan was the book, The Maestro. Right? And when you have a book written about you that says you're the maestro.
The new one is not quite that way.
Well, no, it's not, but I'm
George is a, yeah.
yeah, we got it.
I'm going to direct this to Mike. Oh, sorry. To Mike, but if anybody else has anything to say, I'd welcome here, many of you. Several of you suggested that a single inflation mandate might be one way to limit the political influence on the Fed. But on the other hand, there were periods, Mike mentioned 1926 through 9, and other examples would be 1994 to 2000, 2003 through 8, where the Fed acted as if it was pursuing a stable inflation or stable price level mandate, and of course you had these asset bubbles. And at least some economists have argued that those were periods when productivity growth suggested that there should be some disinflation. So my question is, should we worry that if we did have a strict inflation mandate, it might not prove robust because we might end up with a serious bubbles and crashes that would undermine it eventually? That's my question to you, Michael.
Yeah, I've done a lot of research on these topic of asset price boom busts, and I'm not convinced of the argument that the central bank should be actively managing them. Okay, I think that I'm going back to Greenspan again. Okay, the Greenspan doctrine, which got really pilloried a lot later, I think there's something to it that you don't know at the time whether an asset price boom is going to turn into a bust. And if you look at history for both stock market booms and housing booms, a good number of them don't turn into busts. And so if you work on the assumption that the Fed did in the 1920s, for example, that an asset price boom by definition is going to lead to disaster, okay, you often get a very big problem afterwards. It's not to say you ignore them, okay, but I'm kind of skeptical of the kind of view that's coming out of the Bank of England and a lot of other central banks. The Fed's a little behind the curve on this, is that we need macroprudential policy to deal with asset price booms, and that financial stability, and by financial stability, don't mean lender of last resort. They mean managing asset price booms, that should be elevated to the same level as price stability. I think that's going to lead to trouble in many countries, that central banks that do that. So I'm a little skeptical. I'm not saying that this can't happen, okay, but I think if you do have a simple mandate, low inflation, okay, you do have these asset price boom busts sometimes, but you have them occurring for lots of other reasons too. And to say that by definition, as the BIS guys say, low inflation, by definition, you're going to end up with an asset price boom, and we got to act, we got to manage all the time. I really worry about that.
I want to just add quickly on that. Part of a mandate is not what you should pay attention to, it's what you shouldn't pay attention to. This is, I think, why the Fed should welcome a mandate. If you say it's inflation and unemployment, then if somebody says, well, the weather in D.C. is pretty awful, what are you going to do about it? You say, well, that's not in our mandate. And that's, I think the Fed should welcome that. I spent most of my life in finance. Policy should have a scientific basis, some, understanding of cause and effect. We're vaguely there on money and inflation, not as much as we'd like. The idea that a government agency can detect, deflate, and manage asset prices, booms and busts, tell a boom from a bubble, and then in real time, do something about it when the home builder, whose business depends on house prices going up, when the Fed says, oh, we think that's a bubble, is going to be writing his congressman instantly about it. We don't know how to define boom versus bubble in an operational way, and the idea that the Fed can do it better than any hedge fund, whose job, of course, is to short when they think prices are above. Booms and busts, we can fix the structure of financial markets. Our government gets in the way of short sellers, which is our number one way of dealing with high prices. We can fix the structure of financial markets, but in real time, to think that our Federal Reserve has the technical, scientific capacity to know this is a bubble or not, we should do something about it, they're just not even close.
So Greg up in the back, and then we'll come up here.
This first one is a bit related to what just raised, had to do with financial stability, whether or not you want it in a mandate. And I want to direct this to you, Kevin, because you and a lot of other folks have raised concerns about prolonged periods of quantitative easing and low interest rates having all sorts of profound unintended consequences. They distort market price signals, they create financial stability problems and so forth. But if we were to go towards the more simple one-dimensional mandate that Michael and John are talking about and Charlie have talked about, then the committee would be basically unable to take any of those things into consideration as decisions. We don't care what happens to market pricing. We're focused on low inflation. So, if we're screwing around with the market machinery, so be it. My second question, John, is to you, because you, of course, are associated with this legislation that would create a very strong presumption for the committee that it make its decisions via, a rule-based framework, and you've said what that rule should be. But we also heard Kevin say that a committee benefits from a variety of mental models of ways of approaching decisions. And what I worry about would that be if the Fed was statutorily required to favor one model over another, it would work against that very sort of ecosystem of variety of thinking that ultimately leads to better policy making. So I'd like to hear your thoughts on those things.
Sure.
So Kevin, you go first.
So on the first question, Greg, I'd say first we do see in current use different remits for the world's most important central banks. And yet we see a massive commonality of judgments, directions. Maybe they've been operationalized in modestly different ways, but I'm yet to see in practice in the post-crisis era a difference in remit between a narrow price stability remit and a broader remit that includes sustainable employment and financial stability have a huge effect in practice. So I don't put a tremendous amount of weight on the statutory language in isolation, because as I said at the outset, institutional dynamics matter, of which the remit is one, but only one part, which includes personnel, culture, decision-making, etc. So what about your second question, which is, what if you still were obedient towards this narrow inflation target? The way I think about it, Greg, is it's a medium-term price stability objective. So let me differentiate that from more common recent practice. I do not know the difference between a core PCE in the last 12 months of 1.71%, which is what they say their preferred measure of inflation is, and their objective of 2.00%. These decimal points should be taken as humor. We do not know the generalized changes in pricing in an economy as diverse as this and dynamic of this, of which these generalized changes in prices happen because of literally millions, if not billions, of decisions made every day. So this preoccupation with the 10th and 100th of a point suggests that we are not currently practicing a medium-term price stability objective. You'll recall there was a time, even when I joined the Fed, that we had this thing called a comfort zone. If inflation is somewhere between 1% and 2%, we've achieved that objective. Well, I'm afraid the physicists now believe that they have conquered economics, so we can be much more precise about these targets. So that's one area where I don't think we're pursuing it. Secondly, if John Taylor taught me anything 30 years ago in monetary policy, is that there's long and variable lags. Even if we were good enough to be judging what the changes in prices were, should we be solving that based on the core PC data we got earlier this week? Gosh, I hope not. So finally, on your question about how do you deal with these broader financial stability questions, if you have a medium-term price stability objective, which is different than a price stability objective before our next meeting, you would ask yourself questions which I think is against the orthodoxy to ask. You'd ask yourself about finance. Here's a dirty word we're not supposed to use at the Fed. Money, credit. You'd ask yourself about the financial cycle. You wouldn't be preoccupied with the business cycle, of which you are constantly readjusting your sense of Nehru and constantly adding new hundredths of tenths to your price stability objective. So if you had a medium-term price stability objective, and you had a view that the financial cycle, far more consequential to the business cycle, with much larger loss functions if you have another crisis, then you would keep your eyes on the ball of what actually matters. And you would import into a model that otherwise is looking at real variables of which at this point you probably have limited effect, like the change in the unemployment rate over the next few months, and ask yourself about whether other ideas should be brought into it that relate to the credit cycle instead of the business cycle. So I think in conclusion, you can do it, even with a, quote, narrow remit of a medium-term price stability objective, but that does not look to me to be current practice.
So I'll just briefly answer your question about rules, strategies, and different models. You want to have a strategy that's robust to many different views as best you can, because there are different views. I can't believe that money is a dirty word at the Fed, but whatever, I suppose it is. You want to have models that incorporate...
It's a pretty dirty word.
You want to have other ways to... And there is a part of our research was a joint project with Volker Wieland in Germany. We're getting all the central banks' models and the different models at central banks and examining how different rules or strategies work across that whole set. And so just because you have a strategy doesn't mean you're wedded to one particular algebraic model. That's completely an incorrect characterization. So robustness has always been an important thing, and you want to have that because we don't. There's huge disagreement. I think if I were to say what's gone wrong with policy over the last dozen years, it's actually paying too little attention to the models out there. I mean, they're not perfect models, but going away from them willy-nilly causes problems. Right here in the front.
Thank you so much. I really appreciate the book, chapter on independence in particular. So my understanding is early 80s, interest rates go up. Ronald Reagan does not run against Paul Volcker. Early 90s, interest rates go up. George H.W. Bush is not running against Alan Greenspan. Late 90s, George W. Bush is not running against Alan Greenspan as interest rates stay very low. We have a president-elect who, in his final closing ad, put Janet Yellen in an advertisement with Lloyd Blankfein and George Soros. I understand some of his advisors to be saying that the president need not be hands-off with the Federal Reserve. And so my question, especially to Governor Warsh and Dr. Taylor, is this concerning, good, bad? We shouldn't worry about it, wait and see. What do we make of this?
I'm going to let my former teacher answer that question.
I don't know. Students usually do a better job than teachers. So look, we're debating here whether we need to have a different law or whether the Federal Reserve Act should be amended and changed in some way. So that's a decision that's going to be, if it happens, will be enacted in Congress and signed by the President of the United States. And so the Congress particularly has a constitutional role in oversight of the Fed. And so I don't really see why there's nothing to be said for commenting on how it should be operating. The kind of things that we've all been mentioning here has to do with that. So it seems to me that's the way to think about it. It's it's an institution which has independence. If you think it should be more limited, as I think many of us do, that's something that should be stated. Maybe another way to think about it here, one of the reasons, you've already heard it, to have, whether it's a more specific mandate or a more specific strategy, is it does remove a lot of these political things that come into play. So it's a way to kind of make the Fed more independent and have it be more independent. So that's how I would answer that. Student?
I think
No.
I think you're feeling this tension that in a democracy, your independence goes with limited mandate. And if the Fed were just running monetary policy, that wouldn't have, the ad that you mentioned is when the Fed does political things, it can expect political interference.
My name is Patricia Steins. Two questions related to each other. Dr. Plosser quoted Milton Friedman from 1967, I believe. That's 50 years ago.
Yeah.
That tells me that this is not new. Why the resistance, resistance, or is it on Congress? Is it on the limelight and marketing that the Fed receives when they have so much power? And a related question is, if it's, getting out of the clause of Congress, once that independence is established, how do you walk the fine line? And I would like to hear practical suggestions of how do you walk the fine line between independence and accountability?
Well, I think the fine line is, as I mentioned in my remarks, there's a tension there. And how do you preserve the independence? Because we know history is replete with examples of when that independence goes away, outcomes usually are not very good. So we need to preserve that independence. And I think many members of Congress more or less understand that, okay? But the problem is that gets in the way for them sometimes because they want other things. So it is a fine line. I think Russ is right. There's a lot of conflicts going on here. But I would say that we want to be able to make progress on these issues, and sometimes small steps is the best you can do. One thing I learned in my almost 10 years on the FOMC was that when I first went in there, having been an academic for the previous 35 years, I had all these great ideas, and I've been on the shadow for 10 years or 15 years, shadow for the market committee. I learned to measure success in small steps because it was too painful to keep pounding your head against the wall and to get big things done. But I think, and Kevin made this point earlier, which I also, by making some changes in the law, the mandates, for example, it's not the panacea for everything. But one of the things it does, it begins to change the culture and the focus of the institution, the staff. Things evolve from that. So I think you have to make these changes, recognizing that it's only one step in the process. So I think it is a fine line. It is hard to do, but I think it would be bad just to throw up our hands and say we can't do anything about it and let's live with it. I think that's kind of.
So a question here, and then.
Looking for legislation, and you seem to be arguing that there is a separation between Congress and the Federal Reserve, and I'd like to challenge that assumption. I'm thinking back to a time when there was legislation on the lender of last resort. The chief economist of the Senate Banking Committee was from the Federal Reserve. The Federal Reserve wrote that legislation, which was passed. How do you solve that problem?
Okay, so let me say something. right now, there is legislation, and the Fed is asked to their comments when they come to testify. So far, they say they don't like it. But if that legislation moves, then you would want the Fed to comment on it. They are running monetary policy, so I don't see there's anything wrong with getting advice or thoughts, what they think about it. If they're literally writing it, then of course, then that's a different circumstance. But I think there's an interaction between the Congress and the Fed, which is fine. It's an oversight body, and that's the body that's carrying it out. So I think a healthy exchange would be fine.
In particular, for that one, I would want the Fed participating with Congress to say, okay, here's what we're going to do in a crisis, and therefore here's what we're not going to do in a crisis. And then Congress comes in the crisis and says, bail out my brother whose taco stand is going under, and the Fed can say, here's what we said we're going to do, and here's what you told us to do. We're not allowed to bail out taco stands.
Thank you very much. Adam Crichton from the Wall Street Journal. I wanted to ask a question about the Fed's balance sheet, which was discussed a bit. I understand that about 5 years ago, Speaker Paul Ryan, I think at the time, was asking questions of then Chairman Bernanke and accusing him effectively of monetizing the debt. And the then chairman said, no, that's not the case, because we're going to sell down these securities in the future, and so therefore it won't be monetizing. Now, 5 years on, it's looking less and less likely that that's actually ever going to happen, not only for the mortgage-backed securities, but the treasuries as well. And so I guess my question is, does it matter that these things are never going to be sold, or seemingly never going to be sold? And is that inflationary? Because I was just thinking about it then, like, before, the coupon payments on all those securities were going to the private sector, and now it's going to another arm of government, which then kind of uses those coupon payments for its own expenses, and then it pays a dividend back to another arm of government. And that just seems very, very odd. So I just love to hear your thoughts on that phenomenon.
Well, so we may have a discussion on this. I think it's fine because the Fed is paying interest on all these reserves. It's not really monetizing debt. It's creating it's creating fixed value, floating rate, overnight government debt, which the Treasury could issue just as well. And in the end, from those of us who are outside of Washington, there's one government budget, and the Fed is really on it. There's some games inside. So I don't see it causing any problem, so long as they keep paying market interest on those reserves. I actually think it's useful. Now, it's a big difference of opinion here, but there's one.
Well, I actually, on that point, John and I don't disagree. The economics works just as he said, and the money creation really doesn't occur until that trillions of dollars that are sitting in the banking system begin to flow out into the economy. And the practical challenge the Fed will face is that as or when that happens, do they know enough to be able to move interest rates at the right speed or right pace or the right level in order to manage that process? That's the big question. They've never had to do that before. But it's certainly feasible that could happen. My problem with the big balance sheet is not an economic question, it's a political economy question. So my concern with the big balance sheet, and John's position is well understood, and I agree with it in principle. The size of the balance sheet, as long as you're paying market interest on reserves, doesn't matter. Okay? But what happens, from my perspective, what I get concerned about is when Congress or other entities within the government perceive that the balance sheet of the Fed is a free parameter in the sense that it can be whatever we want it to be, and it doesn't affect monetary policy. So why not use it for other purposes? So my argument a little earlier about Argentina and what's happened recently when in 2008, two senators wrote to Ben Bernanke and said, well, Congress can't decide what to do about the automobile companies. Would you lend them money until we can figure it out? Well, Ben said, no, that's not in our job description, right? He gave the right answer. In Dodd-Frank, however, the Congress created something called the Consumer Finance Protection Agency and basically said, we as Congress are unwilling to appropriate funds for this directly. We don't want the politics of that. We don't want it to be on the books. So the Fed's going to pay for it. So the way the Consumer Finance Protection Agency is funded is out of the Fed's seigniorage. Now, of course, the taxpayer still pays for that because the Fed turns over less money to the government at the end of the day than otherwise. But it was smoke and mirrors. The last piece of legislation was, as I alluded to earlier, the transportation bill, where they couldn't figure out how they were going to pay for the transportation bill. So they raided the Fed's balance sheet. They cut the dividends. They took reserves out of the Fed to do fiscal policy. And so now, when you think about the big balance sheet, when the Fed, and we become known as a balance sheet where it can be any size we want to it. Wait till Congress decides in these new infrastructure projects that both candidates wanted to do, we're going to use the Fed. The Fed's going to pay its fair share. We're going to have them issue debt so we can fund infrastructure projects. I was in Switzerland last month, and I was at the Swiss National Bank, and I was having some conversations with the governor there, Thomas Jordan. Switzerland has a huge balance sheet now, and it has a huge balance sheet because it bought all these foreign reserves because it was trying to manage the exchange rate. They're now under pressure from people in Switzerland and the government to say, okay, you're just a big hedge fund now. What are you going to invest in? Sell these currencies, go invest in Swiss companies, or how to maximize returns on that balance sheet. When you have that big balance sheet, you open the door to political use of that balance sheet for something other than monetary policy purpose. That's what worries me.
Maybe we can agree. If it's a good idea for there to be U.S. government debt, which is interest-paying, fixed value, overnight, and electronically transferable, that's what reserves are. Maybe the Treasury should issue it, and then the Fed could. Then we don't have to have this smoke and mirrors where the Fed buys some treasuries and then issues a slightly different kind of treasury. Yeah. Treasury issue.
You're going in the right direction here.
Yeah. This is a big give from John. I think John.
You're giving in. I like it. No. We've been writing about this since 2009 when the balance sheet exploded. And the best thing would be to get the balance sheet back to a position where the supply and demand of reserves determines the interest rate. Then you don't have to worry about interest on excess reserves. It'd be a much better world. And it's more than political economy. It's really the ability of this institution to do a lot more than I think what people want it to do.
I just wanted to bring in
Hit a nerve here, Alan.
No, I want to bring in an historical note, and that is the last time we had a big balance sheet was after World War II. And what happened was it got worked down. Okay, and what happened also was that in that period we had pretty high growth for a long period of time, and we also had inflation. Okay, and this issue, people think about it today, but back then they didn't worry about it that much. And it wasn't quite as big in relative to the economy or other metrics, but it was still pretty big, and it got worked out. So I think that in part, if they follow the stable policies that they're following, and if the economy does grow, this can get worked out too.
So just two quick things, if I could, John. So obviously you sort of captured. We're having more debate about the balance sheet than, as far as I can tell, is happening in the four walls of the institution that we are big fans of. So I'd say two things. First, on strategy. The theory of the case when Charlie and I were there is we had run into the zero lower bound in a regime of a financial crisis and needed to find some way to circumvent the zero lower bound, so we grew the balance sheet. I should tell you that at the time we did not think that it was our finest idea. Little would you know that now that every major central bank around the world calls this normal operating procedure, even when we're near full employment. But the point was we cut rates to zero and grew the balance sheet, and that would ultimately be symmetrical. We would then cut the balance sheet and raise rates. Well, the narrative from the Federal Reserve has now changed 4 times since that set of entry and exit principles. The most recent, I won't take you through the to's and fro's, was the chair at Jackson Hole, who suggested that having a big, large, permanent balance sheet is invariably a good thing and should be part of our toolkit, even perhaps suggesting that if we could buy other assets, which would be required by Congress, that would be nice. So I'm troubled first that the entry and exit principles seem to change even as we're getting closer and closer to their purported objectives. What about on the substance of it? I would say a couple things. First, I fear that fiscal dominance has become a design feature, not a bug of this system. Look at yield curve control coming out of the Bank of Japan. It seems as though a large balance sheet and fixing the rate of the 10-year is now the objective of policy, And that broad groupthink worries me as we think about it. And as a final point, the temptation to wander into fiscal policy with a big balance sheet is a temptation that we need not give to the central bank. And this is not to altogether in all regimes say we should never grow the balance sheet again. But as I said at the outset, we should have a strategy for peace times. We should tell you the strategy. We should live by the strategy. And we should not wander into other domains just because we think we can do it better.
Question right here, and then Adam.
Hi. On a sort of practical level, given that there's a political scene now where some of these things look like they might or probably will happen, given your knowledge of the institution, where do you think the possible points of compromise are? Do you sense any motion within the Fed itself to start proposing or working towards some of these things so that it doesn't become simply a matter of legislative edict and end up in a big fight?
It's an excellent question. At least if there's possible motion on legislation, there'll be some discussion about whether that should be modified in some way, and maybe there'll be some issue there in terms of compromise or whatever. But another possibility, I don't think this will happen, but it's a possibility, is that somehow the Fed does this on its own. And there's talk about that, to be sure. I think there is an advantage of having the Congress in its oversight role be part of this. That's my sense. It doesn't have to be, to follow this exact thing, but it has to be part of the back and forth. If the chair can come to the Congress now, and sometimes it's very hard to get the questions that he or she will address. It's an art. But if there was a sort of a specific thing that they said they would do that they could be held to, then that would improve that exchange. So I think it's important to preserve that connection, and that does mean some legislation.
So can I just comment
Yeah, sure.
about the Fed doing it on its own in some sense? This is something that I've talked a lot about over the years and more recently as well. I'm not revealing anything because it's in the transcripts now. But you go back to we used to call them green books, then they became teal books. The staff at the Fed produces rules, 4 or 5 rules every meeting. Those rules are simulated, they're put into the evaluation, they crank out the implications of those various, and they tend to be rules that are thought to be robust, which is really important, as John was saying. So they're there. They've done the work to do that. And so I've had discussions with 2 chairs about this. The Fed could do itself a favor and the public a favor by making those public, discussing what those rules are telling the committee, and then discussing why the committee made its decisions that it in fact did. It would put the decisions in a framework. Yeah, you still may not agree with the final decision, but at least it forces them to have that discussion. That discussion doesn't have to take place now, and it's certainly not made public. And I think as a small step that the Fed could have done a long time ago that could have helped shape this legislation in a way and move it along in a positive way, they can do it. And it still puzzles me why they won't, because the work's already done. The work's already done. So I think they could make progress that way.
So Adam, front row here.
Adam White, Hoover Institution. You referred a few times to the Fed's role in financial stability, macroprudential, its macroprudential role. There now is an interagency body on that, the Financial Stability Oversight Council. As you're thinking through how you'd reform the Fed, how would you reform the Fed's role in the FSOC or vice versa?
Anybody want to?
Sure, a couple of comments. If you subjected macroprudential supervision to a Google search, you would find a paucity of literature that predated 2010. If you did the same thing on the Taylor Rule or the broad conduct of monetary policy, these are subjects we've been studying for most of the post-war era. So if in fact we are concerned about the conduct of policy and monetary policy for reasons that puzzle some of us on this stage, has a secondary or tertiary role in financial stability, as the prevailing wisdom suggests, you'd see why you would stand up this newfangled set of tools called macroprudential oversight. And if you say it really quickly, sounds like you've got a toolkit, you understand the tools, you understand how they transmit to the real economy and to asset prices, and how efficient and efficacious this would be. The reality is macroprudential policy 20 years from now might be a very useful tool to be executed upon by high government officials. That is not the state of the art. Never mind the groupthink we have about the conduct of monetary policy. We don't really understand even how these things work. We've seen simple examples in other countries and nation states of tools that may or may not be successful. So I worry very much about putting too much of a burden there, and think it might be because at some level there is a view that monetary policy isn't relevant to financial stability. As a result, you ought not worry about interest rates and a balance sheet, which are broadly close to how they were in 2009 in this current environment, because you have these sets of newfangled tools to deal with it. So I suggest that the suggestion about all that we know about financial stability and macro-pru is quite overstated. And like in monetary policy, even more so, a little humility here is called for.
I want to go one step deeper. I mean, you bring together not just how do we do about the Fed, but what do we do about Dodd-Frank and our whole policy towards banking and financial stability. Where we have evolved is the idea that huge banks will continue, enormously leveraged, but the Fed, who is now has regulators ensconced at all the big banks, will see that they're taking too much or too little risk and tell them to take more or less. And also that the other side of the Fed will now have to monitor asset prices to make sure asset prices don't fall too much. That's the both FSOC and the Fed, where we're kind of going, is that's our approach to managing financial crisis. And once stated, you can see how hopeless it is. The idea that they'll be able to see the risks coming this time, though we never did before, is pretty hopeless. And the idea that the Fed now realizing it's hopeless. That's why is the Fed interested in taking on stock prices and housing price bubbles and credit allocation and so forth? Because they can see that they're not going to be able to keep these banks from taking risks, so they have to stop the waters from rising. They have to stop the markets from falling so that the banks won't go under. Well, this is a whole nother book and a whole nother discussion. That's just a hopeless way to stop financial crises. You know, we have to have a robust system. We have to first define what a crisis is. It's a run. It's not anybody ever losing money. It's not any institution ever doing. And then have a financial system that is stable and not prone to crises. So the problem, you can't just decide what should the Fed do about FSOC. The problem is this larger thing of what we have done about financial crisis. But we have to leave that alone for the next book.
My name is Peter Olson from Brookings. There's some question in talking about accountability, and this is discussed a little in the book, about whether the FOMC has individual accountability, so each of the members are responsible for their contributions, or whether it's group accountability. And the other day at Brookings, Alan Blinder said that he thinks it should be and is accountable as a group, like a football team. You don't say, well, I made the right calls, but the FOMC as a whole was a failure over a certain period, or whereas others, including Dr. Bernanke, he wasn't as sure. He felt like some individual accountability was an important part there. Other institutions are solely individual accountable. So I'm curious what you think. How is the Fed acting, the FOMC acting now, and what would be the optimal way forward to act?
Start with that.
Yeah, I think this is a very interesting and important question. For you to think about the MPC at the Bank of England, they are individually accountable. And so, in fact, what you see at the Bank of England, you see votes of the MPC that are 7-2, 6-3, 4-5 all the time. And each member is responsible for that vote and has to defend that vote or that. I think that has been a cultural change in the United States with that regard. It used to be, for example, I wrote a little piece a year or so ago that if you go back to the 70s and maybe even in the 80s, what you witness is much more frequent dissents within the FOMC by both governors and presidents. I may not have the numbers quite right, but I calculate them. Like from 1976 to 1996, there were something like 150 dissents by governors over that 20-year period, and about 150 dissents by presidents. So it was pretty clear there was a wide variety of views. Opinions were expressed, dissents occurred. Since 1996, we have almost another 20 years now. Since 1996, that 20-year period of 8 FOMC meetings a year for 160, well, 159, because there's one more to go this year. Over that 20-year period, there have been 2 dissents by governors and about 90 by presidents. There has been a big shift in the culture of how voting occurs within the FOMC. I actually strongly favor a model where you have individual accountability, and that in fact that assures that both different views are expressed and made public. And I think it's important for communication from the committee about what the issues are. And I would much rather see that culture revert back to the way it used to be. I don't know whether that will happen, but I think it's an important distinction that the pressure for consensus is a pressure for 2 things. 1, groupthink, and 2, poor communication, because that means if everybody has to agree, that means the statements that come out from the committee are so vague and watered down and shaped by getting everybody to buy in that they don't say very much. So I think that's not a good communication device. That's just my view.
So a question right here.
Wall Street Journal. These are some questions for Kevin, because you managed to avoid them so well earlier. You were named recently to an advisory committee for the president-elect. I'm just curious, what sort of advice do you intend to give him when it comes to Fed governance and the kinds of proposals that he might support? I mean, do you think there's a bigger role for the president to play and maybe signaling support for some of this? And also, you said earlier that you think it's important for the Fed to stay out of politics. What did you mean? In what way do you think that the Fed is political? And obviously, the president-elect kind of made some comments on the campaign trail that he thinks the Fed is very political. Do you agree with those comments, or do you mean something different?
I have preciously little for you on 2 very good questions.
I have to ask.
I'm pleased to serve on the committee that the president-elect established with a broad bipartisan group of business leaders, some policy people, and it'll really be up to the president and his economic team what he wants of this outside external committee. I would tell you that the most successful of these that I have observed was one led by 2 of our former Hoover colleagues going into the 1980 election. And maybe the most important document that has advised the president is a document that George Shultz and Milton Friedman and many of our other Hoover scholars and one-time mentors authored. And in that document, the outside group talked about important first principles of economic growth. And it avoided some of the sort of day-to-day politics of the moment. And so I'd call your attention to that white paper as an important document on the conduct of economic policy and what growth is and isn't and how it can best be performed. And at least as far as my early thinking goes, that'd be a document well worth reading, revisiting before our first meeting of this outside advisory group.
Another questioner asked a practical question. You all have academic interests, so I'll ask a practical academic question. It's Christmas of 2002, and you are the Fed chairman, and you've been visited by the ghost of financial markets future. And you have now perfect foresight what will happen if the mortgage market credit standards become irresponsibly loose. And in addition, you have the complete confidence of all other 18 members of the FOMC. What 1 or 2 things would you do to have the Fed either prevent or materially reduce the financial crisis of 2008-2010?
Okay, so one thing that many of us have been writing about almost in real time is the begin to bring rates back to where they should have been. I put it that point. There's almost 300 basis points gap according to what was done in the 80s and 90s. That'd be one part of it. I think there's a sense of the way the regulations were being enforced, the presence of the New York Fed, say, and various financial institutions in New York could have been monitored better. But those are just a couple things. I don't know if anybody wants to add to that.
So I would just add one more. I think what John said is correct. I mean, the Fed, as a regulator, has done things providing guidance for lending and other that it could have done, I suppose. But I would remind you that through much of that period, there were two people at the Fed who were giving speech after speech to Congress and the public about two other government agencies, Fannie and Freddie. Bill Poole was president of the Federal Reserve Bank of St. Louis at the time. He gave, I don't know, half a dozen speeches during that period about the risk and dangers that Fannie and Freddie posed to the financial system and to the housing market, that they were undercapitalized, and Congress, and Greenspan gave, I think, a couple of speeches too on that topic. Congress just ignored it. And the Fed had no ability to do anything in that regard. So to give at least those two people credit, at least that time, they were focusing at least on one dimension of what I think was a source of the problem.
Right. And Gramlich at the Fed was exactly focusing on the risks, and he wasn't listened to.
I would add here, so this question of interest rates is a delicate one. Interest rates were too low in the early 2000s, but this came up also as to interest rates now. The argument that the level of interest rates has a big effect on the risk premiums in asset markets is a delicate one. It's not obvious. Why should borrowing at 5 and lending at 8 be any difference than borrowing at 0 and lending at 3? It's just not obvious. Everyone treats this as obvious that low rates stoke asset prices, but in fact, the risk premium and the level of rates don't naturally correlate with each other. The things that my colleagues haven't pointed out that I would do is, one, bank equity. What are you guys doing with 1 to 2% leverage, 1 to 2% equity, and we're measuring that charitably? Let's ramp. I take it your question. You can't share your clairvoyance with the rest of the world. Yes, let's get somewhat sensible and historically sensible amounts of bank equity in the way so that banks aren't failing. Second, I wouldn't bail out long-term capital. I wouldn't bail out Bear Stearns. We got in this mindset that everyone expects the bailout, so that when Lehman came, it was, oh my God, they're not doing, if we were in the mindset of bailouts aren't coming all the time, then I don't think we would have gotten in this trouble.
One of the arguments that the Fed often makes for sort of straying from what rules say is risk, and that we have to measure the risks of doing one policy as opposed to the other. And in that sense, it's a sense of humility. We really don't know what the future is going to hold, so we have to measure the risk. What's the counter argument to that? Because that seems to be what drove a lot of the move towards discretion or downplaying what the rules would tell you.
Yeah, so the risk management is definitely part of the. Yeah, I think at any time there's all sorts of things you can be referring to that will take you away from things that worked in the past, and that was one of them. And also the possibility of deflation was mentioned. That was part of the risk management thing. So I think the main thing is you have a constructive way to analyze that, so it's not just a willy-nilly excuse for some discretionary move. Anybody else want to add?
Well, I'll just say just one. I think one of the things that I always found was missing in those discussions of risk management, which occurred quite a bit during the crisis and other times. There was a lot of discussion of risk management, and even in more stable times. I think one of the things that the Fed didn't ask itself enough about was they could focus on the risk of something bad happening in the future, China or deflation or something. But they, in my way of thinking, they didn't do a very good job of saying what are the risks that we're introducing by our own policies, and how do they fit into the overall equation of evaluating appropriate risk. Those discussions I found never to get materialized and discussed. And there would probably be some occasions where that could tip the balance in a different direction.
Okay, We're out of time. Thank you for coming. You can pick up a copy of the book as you go out. Thank you.